But let's talk a little bit more about how the Fed is weighing on markets with JJ Kinahan, Chief Market Strategist over at TD Ameritrade. JJ, it's great to have you on the program this morning. I mean, we were just talking about the importance of the Fed. What's your forecast with how the Fed is going to react given the numbers that we've seen? Consumer sentiment also coming out this morning, well below expectations and a notable downshift from the prior month at 61.7. How do you think these weigh on Fed actions this year?
Yeah, Brian, I think, first of all, they're all just data points. I don't think they look at any one particular point and say, this is the one, so to speak. You look at the trend overall. It's like the employment numbers, you don't just look at one report, you look what's happening over time. But I think you guys are both hitting on the real fundamental point of what's going on right now. And that is, there's so much uncertainty as to what the Fed is going to do. It's making it very difficult on investors. I've had a fairly long career. I don't ever remember a time where we've seen such a wide span in terms of what the Fed's going to do as far as hikes or raises. Usually our argument might be like, they're going to do 2 this year. No, they're going to do 3 this year. Right now, the span is 4 to 7. If you look at the CME Fed Watch tool, they're talking about 5. If, Goldman Sachs just joined some of the others in saying 7 this year. So that's what's really making this so difficult, is the wide volatility within the Fed raise numbers is not something that the market's used to. And I think that's why you're also seeing sort of these hair trigger reactions one way or the other. As far as yesterday's action, the one thing that I will say, even though VIX had a pretty good percentage upside move, it's still pretty contained at this 25 and under level. And the other thing was, if you think about the stock market action yesterday, obviously we were crazy in the 2 years, adding 15 basis points on the day, which is, 25 basis points. The 10-year adding 15 basis points, moves you don't normally see within one day. But the stock market itself, although it was a pretty dramatic sell-off, it was very orderly. So I don't see a sense of panic in the market as much as I see people trying to reprice stocks and say, what does this mean for stocks longer term?
So, JJ, is now the time to be doing that? I mean, to Brian's point earlier, between now and March, there's going to be a lot more data points that come out, a lot more speculation, and things are going to be moving choppy alongside of it. Do you hold cash and leave it on the side, or do you put your money to work right now?
It's interesting. Looking at one of our clients did the last month is, for the first time in a while, we saw our clients starting to buy fixed income products, which it's a little bit of a change in behavior. What I mean by that is, before they'd sell stocks and look to buy the next stock. I think what you're seeing right now is people who, when they're selling some stocks, are either going back in for a smaller amount than they did before, or saying, hold on, let's get past this March meeting. Again, I think all the market really wants out of the Fed in the March meeting is some clarity about where they're seeing the rest of the year. Whether it's 25 basis points or 50 basis points, and again, the probabilities of a 50 basis point, as Brian just said, supersized, it has gone up significantly over the last few days. That being said, it's a little bit out of character for Chairman Powell to do something like that. He tends to be much more methodical if you look at his tenure so far. But we will see that at the end of the day. I think that we would just like some indication of, based on where we're at right now, all other things being equal, what is the Fed seeing for the rest of the year? And you said it in your opening comments. Any type of clarity will calm the markets down.
Let's kind of shift gears to the retail approach then. I mean, you made a good point of the fact that it's just people repositioning. It's not your typical risk off, and that does make sense because you're not seeing yields fall as equities come down. It's actually the reverse kind of positioning here. So when we talk about where people are positioned, TD Ameritrade has the IMX, the Investor Movement Index, that kind of tracks where people are going within equities. What are you seeing on that front? Where are stocks and names and brands that people are gravitating towards and also away from?
Yeah, sure, Brian. And then again, this measures not a survey, it's what people actually did in a month. And so what we're seeing is on some of the buys, that what was most interesting to me is Microsoft, because Microsoft and Apple are two stocks that people tend to turn to in uncertain times. And Disney, which they bought ahead of earnings, which worked out well. We also saw a few maybe surprises. Square, I guess called Black now, not a company that people normally purchase. So seeing unusual activity there was very interesting to me. Rivian, we see the retail client very drawn to this EV market overall, something we continue to see in NVIDIA has been a stock that our clients have been very fond of, if you will, for the last year or so. In terms of stocks that they were lightening up on, Carnival Cruise Lines was certainly one that our clients, ExxonMobil, which may surprise some people, but given the great move that we saw in energy, not really surprising to see people taking profits in a stock that is very widely held in our base overall. So that one, not a huge surprise. And then Walmart, Visa, and a company that I think really is among those that people are really trying to find out what the value is, as I was making the point earlier, Zoom being one of the stocks that people saw.
All right, JJ Kinahan, TD Ameritrade Chief Market Strategist. Thanks for stopping by this morning, and have a great weekend.
Have a great week.